morning. It's really good to see some familiar names, I guess, on Zoom here. I see, Bill Torres, Ramon, good to see you. Amy, I see a lot of familiar faces and names. So thank you guys so much for coming on this call. I want to say thank you also to Laura Halverson with Tri-County Association of Realtors for hosting this class. You guys have always been so good to us and always been so supportive, and we really, really appreciate you guys. My name is Jerry Wu. I'm with First American Title. I'm the title rep in the area. I also have Eric Nestor here. Why don't you introduce yourself, Eric?
Hey everyone, good morning. My name is Eric Nestor, and together Jerry and I are a trilingual title team. So we're here to help you, and I'm excited to share today.
Yeah, trilingual Chinese, English, and Spanish. Eric speaks Chinese, I speak Spanish. So not really, but anyhow, we wanted to do this quarterly title class for you guys. So today, the goal of this class is to go over not just the basics of title, because I know we have some newer agents on this call. So we are going to go over the basics of title, but we're also going to focus in on some of the red flags that we commonly see, things that I see and Eric sees that delay the closing process. So we want to make sure we address those, and also go over the different investing methods. We still always have agents asking us, hey, what should my buyer choose? Joint tenant, tenants in common, trust, how does it work? Who should I be dealing with in a trust, and so forth. So we're going to be touching on that as well. All right. I also want to say hi, Esther. Esther is our new ARIA Tri-County President of 2021. So thanks for being on call, Esther. All right, guys. So we're going to go ahead and get started here. If you don't mind, I'm going to share my screen. And then if you do have any questions as I'm going through this, please put them in the chat box, and then Eric's going to make sure that those get addressed, okay? So hopefully everybody can see this. Eric, this coming through?
Yeah, we can see it.
Okay.
And also,
so let's start with
information. Sorry, Jerry. I put our information in the chat box. If anyone wants any of the resources that we'll mention throughout the presentation, feel free to shoot us an email. It's a little bit more difficult to get everyone's name and contact if we don't already have it, if it's in the chat. But I put our information in the chat, so it's there for you guys.
Awesome. So thank you so much. So we got to tell until about 11. I'm going to try and wrap it up by about 10:50. So then we have some time for question. Now, to start off, let's start with the basics, guys. I know for some of the more experienced agents, this is going to be a little elementary, so bear with me. But let's talk a little bit about basic title insurance. What is title insurance, right? So title insurance protects you against covered title defects like a previous owner's debt, liens, and other claims of ownership that may have been instituted prior to the purchase of your home. Now, I've said this many times, all that really is saying is that title insurance ensures that the property you purchase is yours. It's a type of insurance for ownership, right? So I know you're thinking, why do I need insurance for ownership? If I go buy something, isn't it inherently mine, right? If I go to Target and I buy, maybe I buy a book, I give them money, they give me the book, it's my book. There's really no question. I don't need to go out and buy an insurance policy saying that it's mine, right? Now, real estate is a little bit different. Now, even auto insurance, right? You go buy a car, you get insurance, but the insurance is really in case you get into an accident, not to insure, not to say that this car is yours. So what makes real estate different is the fact that it's a lot more complex, right? So there's a lot more ownership prior to you owning the home, probably. There's a lot of liens that could be on the home. There could be a lot of easements. There could be a lot of agreements. There could be many, many things that can come back and threaten the ownership of one of the biggest investments that you just purchased. So that is why title insurance exists, to make sure that when you purchase something, a property, that you have insurance saying that anytime somebody from the past or some entity from the past comes back to threaten the ownership of your property, you are covered, right? And that's what makes buying property in the United States so special, because not every country has this. So a lot of foreign investors, they come in, they purchase the property, they have title insurance, they feel secure about the purchase, and then they can go back, whether to, their country or wherever, knowing that their property, their investment is secure. So it's a very, very unique type of insurance that's really only unique to the United States and some selected countries. So I talked about how title insurance is different than traditional insurance policy. Also, I want to touch on this a little bit more. Title insurance is a one-time premium, guys. So whereas opposed to other insurance, we all have insurance, right? We all have car insurance, we all have health insurance, maybe we have life insurance. All types of insurance, if you think about it, works similar in the fact that you pay, once a year, maybe twice a year in case something happens, right? But you continue to pay. So title insurance works backwards. We do all the work up front, all right? All the research up front before the close of escrow, and then there's only a one-time premium, all right? Let me repeat that. There's only a one-time premium. You're not paying a premium every year to continue to have coverage. You have title insurance coverage for as long as you own the home, for as long as you own the home. Now, there's typically in a transaction two types of title policy that gets issued. One is the owner's policy, and one is the loan policy. The owner policy is what I've been talking about. It's the one that ensures that you own the home and there's nothing that comes back and threatens the ownership of your home. That's the owner's policy, and it's good for as long as you own the home. All right, now that's the key phrase here, as long as you own the home, guys, because if you buy a property, let's say Eric buys a property today, and then after the close of escrow, he's like, you know what? I'm going to change the title of my property to Jerry. I'm just going to give it to him because I like him. He's a nice guy, whatever the reason. Once he deeds the property to me, he has no more title insurance. All right. So he owns he has coverage for as long as he owns a home, 50 years, 60 years, 70 years. But as soon as he deeds that property to somebody else, that policy is no good. The story I like to tell is, we had a situation, not us, but it was one of my clients that had a situation where his buyer bought a property, and the property unfortunately had a loan that the title company did not find. All right, so the property, I guess it was LA County, and then they recorded this lien in a different county. Either way, the title company that worked on it did not find that particular loan. Now, this buyer buys the property. After he buys the property, he changes it to his LLC, all right? An LLC is a separate legal entity. Keep in mind, all right? It's a separate legal entity. So after he changes it to an LLC, he changes his own title to the LLC, he gets a letter from the bank. The bank says that we have a loan on this property, and when the property sold, we did not get paid. So now you're the owner, the house is the collateral, we need our money. So he's like, well, I guess I'll just file a claim with my title company. They missed this loan, they missed this lien on title. So he filed a claim with his title company, and then his title company denied his claim. And the reason why they denied his claim is because he changed the title of his home to his LLC. And the title company insured him as an individual, not his LLC. So they actually denied his claim. Now, in this particular example, there was something that he could have done to work around this. When you change title to your own LLC, right? Let's say Jerry Wu buys a property and I change it one day to Jerry LLC, JW LLC maybe. If it's my own LLC, I can actually go back to the title company and then purchase an endorsement. The endorsement typically costs about $100, and that endorsement will allow me to continue to have coverage as long as it's my own LLC. All right, that's the key word. As long as it's my own LLC, I pay $100 for the endorsement and I continue to have title coverage. All right, that's the only type of situation. If he had gotten that endorsement, he would have continued to have title coverage. But if I change it to like Eric as an individual, then there's no endorsement for that. That's it. All right, there's no more policy. Now, the other type of policy is a loan policy. This is issued when there is a loan on the property, when the buyer is coming in with a loan. All right. So typically, this loan policy is paid for by the buyer, and it's only good for the term of that loan. So if that loan, what happens when we refinance? When we refinance, one loan gets paid off, and then there's a new loan. So every time you refinance, you're going to see a title insurance fee, and that title insurance fee is this loan policy because it's only good for the term of that loan. All right. I talked about how long the policy lasts. How much does it cost? So title insurance, like any other type of insurance, is based on the amount. That's how we base our premium. So the more expensive your home is, the more expensive the owner's policy. The more expensive the loan amount is, the more expensive the lender policy. Okay, just to give you an idea, $500,000 home, you're looking at about maybe $1,600 for the owner's policy. So it's not cheap. Okay, and every title company, we're all about the same in price. There's not really a big difference. So, so my point being that it's one of the more expensive fees on the closing sheet, on a final closing sheet. So your client might ask you, hey, hey May, like, or I saw that there's a, fee for title for $1,600. Like, what is that? So hopefully at that point you'll be able to kind of give them an answer. All right, so that's it for this section. Does anybody have any questions before I move on? Feel free to ask. There's no stupid questions. There's no dumb questions. If you have a question, please feel free to ask.
Nothing in the chat.
Hi, I have a question.
Yeah.
Yes,
Hi.
my name is Alice. So talking
Hi,
about the title protection, if changed to LLC, what about if family member add into the title, like parents title at the beginning and then add the son or daughter name to the title, what should they do? What is the procedure?
That's a good question. So that's okay. You will still have title coverage because one of the person on title, one of the originally insured is still on title. So let's say I buy the home and then later on, I include Eric on title. So that's okay because I'm still on title. I'm one of the insured, so we still have insurance policy. So that's okay in that situation. It's also okay to transfer to my own trust. In that situation, I do not need an endorsement if I transfer to my own trust.
So for adding another member, do I need to inform title insurance company or just add it?
Generally you don't. You just need to have a grant deed prepared, and then the person that's on title will sign the grant deed. So like for example, A transfer to A and B, right? So it's a transfer, it's not adding. There's no such thing as adding or removing somebody from title. I think that's something that we all have to really realize. There's no such thing as adding somebody on title. It's all about transferring. So A is transferring property to A and B. So A then will sign the grant deed in front of a notary, just like in a sale. And then once that grant deed is signed in front of the notary, it gets sent down to the county recorder to get recorded, and that's it.
Okay, got it. Thank you.
Hey, Jerry, Dan Lee is asking, who pays for the loan and owner's policy?
Good question. So the owner policy here in Southern California, guys, and it's different everywhere you go. So keep that in mind. Here in Southern California, it's typically the seller that pays for the owner's policy for the buyer, right? So the seller pays for the title owner's policy for the buyer. And then when that buyer sells, then they're buying it for the next buyer. The loan policy is typically paid for by the buyer in this situation. But if you purchase a new house, a lender might tell you to just, hey, you pay, the builder might tell you to just pay everything. But in a resale, typically the seller pays for the owner policy for the buyer, and then the buyer pays for the loan policy for the lender. Okay.
Awesome.
All right. Okay, let's move on. So let's cover now. We talked about the basics of title. Let's talk a little bit about the different ways of holding title. All right. And guys, if you want like a copy of this flyer, we actually have this flyer in different languages. We have it obviously in English. We have it in Spanish, Chinese. I think we have it in like, I don't even know how many of different languages, but there's a lot. So just email myself or Eric afterwards and we can send you this flyer in whatever language that you like. So I'm going to talk a little bit about vesting and the different ways of holding title, because if you represented the buyer, more than likely you run into the situation where they ask you which one should they choose, right? Joint tenant, tenants in common, and so forth. I'm pretty sure. So let's start with the most basic and simple, which is sole ownership, when there's just one person on title. Now, keep in mind, guys, when we talk about vesting, this is considered legal advice. So we do not want to tell our clients what to do, right? Because then you would be giving them legal advice and tax related advice, and that could get you in trouble. So stay away from telling them what to choose, but you must understand it so you can at least explain to them the differences and then have them choose themselves. All right, so protect yourself in that respect, because how they choose to hold vesting can have big effect on what happens to their property if they were to pass away, and their taxes as well. So let's start with sole ownership. Sole ownership is very simple. It's just one person on title. So today, Mark Smith, making up somebody, Mark Smith buys a property and Mark Smith is a single man, then he's going to hold title as Mark Smith, a single man. If today Mark dies, he passes away, then his property actually goes into probate, right? It goes to probate court. The court then determines what happens to Mark's property. Mark can also be an unmarried man. So it'll be Mark Smith, an unmarried man. An unmarried man, guys, is basically the same thing as a single man. All it is just a person who's been married and then divorced. All right, that's it. So if you're married, you're never single again. Just remember it like that. And then you have a married man as his sole and separate property. So this is an example where Mark Smith is married, but he's on title by himself without his spouse, right? So some of you have been doing this for a while. You know, if Mark is married and he wants to be on title by himself, his spouse, he must sign a quitclaim deed, right? So, and then he would be on title by himself. Now, good question comes is, what happens if Mark Smith is on title as a married man as his sole and separate property, and then he dies? Does the property automatically go to his wife or his spouse? And the answer is no. The property has to go through probate because he's on title by himself. So even though he's married, the property goes to probate. And through the probate process, it might go to his wife, but we don't know that. Okay, it's not our call to make. That's for the probate court. Now, what if Mark Smith is married, he wants to be on title by himself, but his spouse cannot sign the quitclaim deed? Have you guys run into that situation? Right, your client is married, he wants to be on title by himself, or she wants to be on title by herself, but then the spouse can't sign the quitclaim deed. So generally speaking, if your buyer is purchasing with a loan from a lender, the lender is going to require the spouse to sign a quitclaim deed. There's no way around it, all right? Unless it's like a private lender, they don't care. But if it's any bank, any traditional lender, the spouse is going to have to sign. Now, if your buyer is purchasing all cash, right? So pay attention to this part. If your buyer is purchasing all cash, then the spouse does not have to sign, right? Because the title company, we don't care. We're not going to ask for it. So the spouse would not have to sign, and Mark Smith can be on title by himself as a married man without the spouse signing. But eventually the spouse will. When Mark goes to sell or refinance his home, then at that point, the spouse will need to sign. So it's only a matter of time, sooner or later. Okay, so those are the, excuse me, those are the main ways to hold title by one person, sole ownership. Now let's move on to some of these methods that I know many of us have seen and has questions about. So let's start with the most basic one, right? Or let's start with the first one, I'm sorry. It's tenants in common. Now, if your buyer tells you, hey, Jessica, I want to buy property. I want to have 60%. The other buyer is going to have 40%. That's how we want to hold title, right? Maybe, maybe the property is 100,000 and I'm spending 60,000 of it and my partner is spending 40,000. So we want to be on title at 60/40. The only option at that point is tenants in common. That's the only option that allows you to hold or allows multiple owners to hold separate interest. However, with tenants in common, there is no right of survivorship benefit. That means if party A passes away, party A's portion goes to probate. All right, goes to probate. Joint tenant works almost the complete opposite. So joint tenant is anybody that's on title as joint tenant holds equal ownership interest. All right, equal ownership interest. And there's also an automatic right of survivorship benefit. So that means if party A passes away, party B becomes the owner. There's some paperwork to file, but really simple, really easy, no probate. So if you take a listing and then your seller tells you, oh, actually the other person that was on title passed away, first thing you got to do is call myself or Eric, and then we got to check for you how they held title. Because if it was tenants in common, then that probate might not be necessary. If it's joint tenants, then we file a couple of pieces of paperwork. I tell you guys to go get a copy of the death certificate, and we're good to go. All right. And then last one I want to talk about is this one. We're just going to skip this one because they're so similar, but we're going to talk about community property of right of survivorship. Now, community property of right of survivorship is very similar to joint tenant. They're very, very similar. The main difference being that community property of right of survivorship can only be used by spouses, husband and wife. In California, husband and husband or wife, but only reserved for spouses. And there is also an automatic right of survivorship benefit. So if party A passes away, then party B gets the home, no probate. Now, what's making community property right of survivorship so much more popular for spouses over joint tenant is the fact that with community property of right of survivorship, there's actually a better tax advantage. There's a better step up tax advantage with this option. And the step up tax advantage has to do with capital gains tax when one party passes away. Now, some of you might have gone on like the probate classes that Tri-County hosts and so forth. So you might have heard about the step up. So I'm going to try to explain it, probably not as good as they do, but we're going to try and I'll try and explain to you what it means. Let me see if I can. Sorry, guys, let me play around with my screen here. Here we go. Okay. So we're going to talk about step up tax base. So this, again, guys, we're talking about step up tax base that has to do with community property and community property right of survivorship. This has to do, again, with capital gains tax when one party passes away. So let's say in the year 1980, somebody buys a home for $100,000, right? Today, in 2021, that same home is worth $1 million. So this is the fair market value of the home today, and then this is their base value. Now, if they were to sell this home today, they would make $900,000. They would gain $900,000, and they would have to pay taxes on $900,000. I understand single people have $250,000, married people have $500,000 exclusion, and there's also some other stuff, but we're just going to oversimplify this example for the sake of teaching this concept. All right, so if somebody buys from 1980, 100,000, that's their base. Today, the property is worth $1 million. They sell, they're going to make 900,000. Then they have to pay capital gains tax on 900,000. That makes sense, right? Now, let's say the property purchased in 1980, same example, was by a husband and wife as community property with right of survivorship. All right. So again, they purchased in 1980 for $100,000. They hold title as community property right of survivorship. And today, that same property, which they still own, is worth $1 million. Unfortunately, the husband went out for a drive. Maybe he was a little careless, gets into an accident, and then he passes away. What happens? So when that happens, the base value will then step up to become the fair market value on the day the husband passed away. Let me repeat that. So if the husband were to pass away today, then the new base value will step up to become the fair market value on the day the husband passed away. So if the husband passed away today, then the new base value becomes $1 million, right? So now this is our new base. So the wife feels very sad. She doesn't want to live in the house. She says, I'm going to sell the house. I'm going to call, Amy, help me sell the house. And then Amy puts it on the market. It goes into escrow for $1 million, right? Because that's the fair market value. Well, the base is $1 million. She sells for $1 million. There's zero capital gains. She pays zero capital gains tax. Right. So that's the power of step-up tax base. I hope that makes sense. If you, I'm going to stop for a second. If you guys have questions, type them. Let me know. Unmute yourself.
Yeah, there is two questions, not on the step-up tax base, but one from Jose. He says, if the son has a power of attorney and the mother passes away, does title automatically transfer to the son?
Good question, Jose. It does not. So a power of attorney is only good to use when that person is alive. All right. So a power of attorney is used, for example, let's say today, I want to sell a property that I own, but for whatever reason, I can't sign paperwork because I'll be traveling or whatever. So I said, hey, Edmund, can you be my power of attorney? I'm going to sign, help me sign all these documents for me to sell the house. Then he says, yeah, sure, Jerry. So I signed a power of attorney, appointing Edmund as my attorney in fact, and then Edmund can then sign all the paperwork for me when I sell the house. But that power of attorney is only good while I'm still alive. If I pass away, then Edmund's completely out of the picture, and that's it.
Next question, Ramon. When title is transferred into a living trust, can you still be protected by title insurance?
Yes. So Ramon, when if you buy a property and you are insured, right, and then you transfer it to your own trust, right, it has to be your own trust. That's a key word. Then you will continue to have title insurance coverage. You do not need to go out and get an additional endorsement coverage.
And Rosalind is asking, how do we get the benefit of step up? Do we purchase that with title during original process?
So it's just how you hold title, Rosalind. So if you, when you bought your property, if you hold title as, Rosalind and Michael, husband and wife, as community property of right or survivorship, then the fact that you hold title as community property of right or survivorship means you will get the step up tax base in case anything were to happen to you or your husband. And then domestic part, sorry, go ahead.
Oh, Amy asked, does domestic partnership hold title as community property?
Domestic partners can hold title as community property. Yes, yes, that is, they can do that here in California as well. All right, so I think we're gonna move on to the next section. If the couple divorce, how does the tax base change? Well, if the couple divorce and the tax base, I don't think the tax base changes through a divorce, not that I know of. They might want to talk to a CPA because after a divorce, a lot of assets are being moved around. But in terms of tax base for capital gains tax purposes, I don't think there is any major association. But again, I'm not a CPA. It's a very complex process. So definitely check with the CPA. I will say this. We're talking about capital gains tax. Now, what about the property tax? So keep in mind, any transfer between husband and wife does not get reassessed. The property tax does not get reassessed. It does not change. Okay, so that's something to keep in mind for any transfer between husband and wife. And that's even with the new Prop 19 law. All right, so let's continue and move on. So I wanted to talk about, so you can always, Tiffany, to answer your question, she asked, does the step-up tax base apply if you change title to community property later on? And you can, yes. So you can change title you can change vesting anytime you want. If you bought the property, if you guys purchased the property as joint tenants, you can still change it to community property. And the way you do that is you just record a deed from yourself to yourself, but then you just change the vesting. That's it. And then the other way I want to talk about holding title is under trust. So if you hold title under a trust, that's actually one of the best ways of holding title, because there's a lot of benefits, such as, right, you know, there's no probate, there's no infighting amongst family. You also get a step up tax base when the beneficiary inherits the property. So let me tell you guys a little bit about trust. So with a trust, there's trust can be simple or complicated, but it always has three main roles. You have your trustor, which is who owns the trust. So who owns the trust is like if me and my wife goes to an attorney and creates a trust, we own the trust. It's our trust, right? So we're the trustor. Then you have your second role, which is the trustee. The trustee is who manages this trust. So while my wife and I are around, it's typical to see us also be the trustee, right? So we are the trustor and the trustee, but we'll also name successor trustees. So one day when we're not around anymore, that successor trustee would then, you know, make sure all the instructions within the trust are followed, right? So if you're working with a client, if you're working with a seller and the title is under a trust, right? And then maybe, you know, you're working with the son because the mother and father passed away, we'll want to actually verify, we need to see a copy of that trust to, one, make sure that the son is the successor trustee, that you're working with the right person, because that trustee is going to be the person who signs all your documents, right? The trustee is going to be the one that signs the listing agreement, the grant deed, anything. That's the person that's going to be signing. So we need to make sure you're dealing with the right person when, for example, if somebody on the trust passes away, right? And the third is the beneficiary. The beneficiary is self-explanatory. It's typically just, you know, if it's a family trust, it's the kids who benefits from the trust. I think there's a couple of questions, right? Let me see.
Yeah, Rosalind is asking, but do you pay again? And that came in after you explaining the change of vesting. So Rosalind, you only pay again for the new deed that you're recording. So escrow or a recording service will draw up a deed for you, and it'll transfer the property from you to yourself, just changing the vesting. So for example, you as a joint tenant to then you as community property with right of survivorship. You only pay the fee for the document that's drawn up and the recording fee at the county, not for the whole title insurance. And then Santiago is asking, if owner changes vesting from joint tenants to sole owner, will the property taxes go up if she is a senior citizen?
So if the property tax, yes, if they change, if it's like A and B and then A changes to B, then a portion of the property could be reassessed. Now, under the current Prop 60 and 90, if it's, you know, between like parent and children or grandparent to grandchildren, then it's excluded from reassessment. But that's only under the current law. The new Prop 19 law does change some of that. So, but if they're not related by parent or children or grandparent, grandchildren, and they do a change from joint tenants to sole ownership, yes, a portion of it could be reassessed, even if she's a senior citizen.
And Diana,
and then we do have Eric and I do have a great webinar to the new Prop 19 law. So if you guys want to watch that, send us a message afterwards, and we'll send you a link to that webinar. Really, really good information hosted by two attorneys that specialize in Prop 19.
Yes, and Diana is asking, what is the difference between community property and community property with right of survivorship?
So there's really not much difference, Diana. So it's just that with community property, that if one person passes away, it goes to the surviving spouse unless a will says otherwise. All right. Whereas with community property or right of survivorship, it just automatically goes to the other person, will or no will. So typically we just see, I mean, 90% of the time we see people use community property survivorship, but they both have the step up tax base. They both are only reserved for spouses. It's pretty similar. So I want to actually finish touching on trust because it's actually pretty important. So I ended up earlier saying that, you know, a trustee is the person who signs everything. So you want to make sure if you're dealing with the seller that's a trust, make sure you get a copy of the trust so we can verify who's the seller, especially if somebody passes away from the trust. Now, if it's like just their own trust, if it's like Jerry Wu, trustee of the Wu family trust, and I'm still around, I'm the trustee, we don't need to see a full copy of the trust. But if I'm not around and my kids are trying to sell it, then you bet we're going to ask for a full copy to see, to make sure that whoever you're working with is the actual successor trustee. Couple more things about the trust. Most trust, I would say like 80 to 90% of trust do not allow the trustee to use a power of attorney to sell a home. All right, so we have run into this a few times where the trustee says, hey, I'm going to use a power of attorney to give it to somebody, to give it to my son or whoever, to my daughter, to help sell and sign the paperwork. Well, we have to actually review a copy of your trust to see if your trust actually allows for a POA to be used to sell the home. And I'll tell you guys, most of the time it does not. So keep that in mind. Third thing about trust, if your trustee is still alive, but maybe they have Alzheimer's, maybe they're mentally incapacitated, for whatever reason, they cannot perform their duty as the trustee, we still have to review the trust to see how that person can resign and then allow the successor trustee to come up to act as trustee. A lot of the times, those trusts will say you need 2 doctor's notes in order for the successor trustees to, you know, come up and act and replace the original trustee. So we run into that situation where people say like, hey, I can't get 2 doctor's notes, you know, can you help? And when we run into that situation, guys, there's really nothing we can do because we have to follow the instructions within the trust. Okay. So, and then the last point of a trust is make sure the title of the home is under the trust. It's so sad when I see a situation where the mother passes away and then the son is trying to sell the house. Same thing, this is an actual case that happened for a property in Walnut a few months ago. Mom passed away, son's trying to sell the house. He's like, don't worry, my mom had it, you know, trust, I'm the successor trustee. But you know what? She never actually recorded the title of the trust, title of her home into the trust. She did have a trust, but she never recorded and changed the title into the trust. So the son ended up still having to go through probate. And then the court, you know, the court then put the title into the trust, which then allowed him to act as successor trustee, which, you know, it was supposed to be like a quick few week sale that turned into months. So really sad to see, but there's not much we can do unless that probate process is done. So those are the main ways of holding title. You can also hold title in LLC, corporation, and so forth, but those are the ones that I wanted to touch on and talk about. All right. All right. Let us move on. We got 10 minutes left, so I want to actually go over some of these pretty quick. Now, I want to talk about some red flags on title now. All right. So these are the things that we see most common that also delay the transaction, including some of the things we talked about. So let me. Hey, Eric, is my slide showing?
No, it's not right now.
Okay, let me do this. Oh, you know what? Before we talk about title red flags, I want to talk about another thing that delays closing. And this is something I think a lot of people on this call can relate to. You have clients that are overseas, maybe they're in China, maybe they're in, you know, wherever, and they have to sign at the embassy, all right? I've made a post about this. I made some videos about this before, but I'm going to continue talking about this because we still run into issues. A lot of the times, the notaries at the U.S. Embassy, whichever country, they make mistakes. And then when that document gets sent back to the U.S. to record, the county will reject the recording. It's not the title company that rejects the recording. It's the county that rejects the recording. So there's literally nothing we can do. So you want to make sure that when your client signs a document at the US Embassy, that it's done right the first time. All right, so I'm going to talk about what makes a good notary. So first of all, this is bad, this is good. So what makes this bad? This is bad because one, you see the stamp here, it's covering notary verbiage. If your stamp is covering the verbiage of the notary section here, the county will reject your recording, very likely. Okay, so this must be a very clear stamp, like something like here. You see how it's very clear, it's not covering anything. This is probably okay, but this is much better, okay? The second thing is, you see here who appeared. Usually you need to write in the person who appeared in front of the notary to sign. If they don't write this in, this will get pulled for recording. And this must match the name that's on the grant deed. We've seen situations where the seller on the grant deed, the person who's signing, is called Eric Nestor, right? Eric Nestor. But then they'll write Eric M. Nestor, like they'll put a middle initial here. When they don't match exactly the same, that will get pulled. All right, so just stupid things, little things like that, right? We always try to catch it. And if it's like something like that, we might be able to help correct it, although we're not supposed to legally correct anything in the notary section. But like this is hard to correct. So just make sure that your clients, again, stamps aren't covering any portion of the lettering, and then they write in their name. I blacked it out here, but they write in their name exactly like the way it is on the grant deed, okay? And usually we'll be okay from that. Also, another thing with notaries, those are notaries signed overseas. What if you have notaries signed here? Guys, notary fraud is one of the biggest fraud in our industry happening right now, okay? And it's very simple. Notary is that's like very easy to do notary fraud. I mean, really, all you really need is a stamp, which you can probably buy online on Amazon or Etsy or something like that. And then a notary journal, which is not very hard to get, right? So title company is very, very scared of notary fraud. We're very, very aware of it, and we're very cautious against notary fraud, because if that means anybody can sign for anybody. So who signs those documents, who does the notary, is very important. Most title company will say, hey, we only want the notary to be done by the escrow company, or by a notary that the escrow company knows, or a notary that's approved by the title company. If you go get the grant deed signed by just a random notary at the UPS store or somewhere, many times, and then we get the document back, the title unit, the underwriter, is going to be like, who signed this? Who's this notary, right? We don't know who this person is. Is this legit? And imagine, this does cause closing delays, because imagine we get a document back the day before closing, we get the grant deed back the day before closing, and then underwriting looks at that notary and it's like, is this the escrow? No. Is this a notary that escrow knows? No. Is this a title company approved notary? Nope. And then underwriter is going to be like, then we need to actually get more information. And then now that your file's supposed to close tomorrow, we're all scrambling to actually get this cleared up. So notary is very important, okay? All right, so a couple more things, a couple of more red flags. These are actual prelims. And let me talk about an example that's not on here first, is uninsured deeds, all right? So an uninsured deed or an uninsured transfer is any transfer that happens outside of the purchase escrow. So if today Eric and I buy a property together, right? We buy the property, and then, after we close escrow, we do another deed taking myself off title. That's an uninsured transfer. And anytime there's an uninsured transfer, the title company in the future is going to want to verify that transfer. So same example, let's say Eric and I buy a property together, and after we close, I deed off, now it's just Eric. 2 years, 3 years, 4 years later, Eric decides, I'm going to sell this property. He gets it into escrow, they open title, And then on that title report, it's going to say like, hey, we saw that there was a transfer of title from removing Jerry. We actually need Jerry to sign an affidavit stating that he actually signed this document, removing himself from title. The reason why the title company asked for this is because, again, fraud. We want to know, does Jerry really know what he signed? Did he really actually sign and deed himself off? What if it was elderly abuse, right? What if Jerry's like some old person Eric manipulated the signature? What if Eric got Jerry super drunk and then Jerry signed something he wasn't aware of? What if it was notary fraud and Eric just forged Jerry's signature, right? All these things could potentially happen. I'll tell you what, guys, fighting feuds between family is like the #1 reason. Like a lot of times people will tell me like, oh, it's okay, they're all family, it's all good. Honestly, more fraud occurs amongst family members than anything else, right? Like mom owns the property. She has 5 kids. 5 days before she passes away, she deeds the property to 1 kid. Does that sound suspicious to you, right? It might, if it does, it probably is. Like 5 days before she passes away, she deeds it to 1 kid and she has 5. Was that a valid signature? Was she manipulated? Was it, was the mom coherent when she signed? All these things are questions. Also, let's talk about this one. This is a deed of trust on the prelim. A deed of trust is just a loan, right? Mortgage loan. Now, when you have a mortgage loan on a property,
we can't see
and
your
then
screen anymore. Sorry.
Oh, shoot. I'm sorry. Thanks, Eric.
Yep.
So this is a deed of trust showing on a prelim. When you have a deed of trust, it's a mortgage lien. When that mortgage is paid off, the lender will record what's called a reconveyance. And then when we see the reconveyance on title, and then we see the deed of trust and they match, then we know that that particular loan has been paid off. The thing is, the reconveyance can also be forged, right? It can also be fraud. So what might appear to be a free and clear property may be actually not a free and clear property. So, so title companies sometimes wants to verify, saying, hey, we see that you paid off your home. It wasn't through a refinance where you paid off your loan, and it wasn't through a refinance. So we need to get a little bit more proof, proof of full payment. We need to get proof that you really did pay off that loan, right? Here's another thing. What if you paid off this loan with Wells Fargo for $333,000, but then the lender does not record a reconveyance? They just forget. It happens, all right? So then now when Warren and Betty goes to sell the house, title is going to come up and bam, this loan is going to continue to show on title because the lender forgets to record the reconveyance. Now, if it's Wells Fargo, not a problem. Warren and Betty's going to call Wells Fargo. Wells Fargo is going to be like, oops, yeah, you're right. This loan is closed. We're going to issue the reconveyance. We're going to issue a letter. We're good. But what if it's Countrywide, right? Who's out of business? Imagine how hard it is to get that reconveyance at that point. What if your lender is a private lender, right? What if that lender was like some guy you knew from 15 years ago, and now you paid off the loan that you owed him? He never recorded the reconveyance and he's now nowhere to be found. What happens then? Have a situation today on another file where my client's like, the aunt lent money to the owner, and then the aunt passed away and they never recorded a reconveyance. So that loan is still showing on title. What do we do? So all of these little things can affect that, what seemingly is super simple, right? Like I have a loan that's been paid off. Okay, so that's reconveyance is actually very, very important. Last thing I want to talk about, guys, is the statement of information. Let me see how that was that example. So sometimes on the prelim, you're going to see something like this. Any defects, liens, or encumbrances or other matters which name parties with a similar name as Anthony Luna. This is just the seller's name, okay? So when you see something like this on the prelim, this is saying that, hey, we want a statement of information from these 2 people. And a statement of information, if you sold a home before, you've seen it. It's just that document, 1-page form where you ask for the Social Security, birthday, where you've worked, where you've lived. And the reason the title company asks for that is because we need to find all liens and associated with these people. Some liens are not attached to the title of the home, right? An IRS lien might not be attached to the title of the home, but we still have to find it. Or what if people have similar names, right? What if your seller's name is Michael Smith? There's tons of Michael Smith in the world, right? And then how do we know which lien belongs to our seller, Michael Smith, or another Michael Smith? So the statement of information will help us determine that. And the sooner we get that statement of information back, the better. Oftentimes, the delay that we see is because we get the statement of information back 2 days before the close of escrow, and it takes us like a day to run the statement of information. So imagine if we get that back 2 days before the close of escrow, it takes us 1 day to run it, and boom, child support judgment pops up, IRS lien pops up, right? At that point is usually when we start getting phone calls like, hey, how come this is just happening last minute? Hey, how come this was missed? And many of those times it's just because that statement of information was turned in too late. My advice to you guys, when you take the listing, when you sign that listing contract, or when it first goes into escrow, you get your seller to sign that statement of information and return it back to the title company immediately. Okay, and then we have sufficient time to run it. And if something does pop up, we have enough time to address it. We literally had, this is, I think in 2018, I think when there was like a government shutdown. I remember this vividly, where a statement of information came in like 3 days before the close of escrow. And then this guy had like IRS liens, like tons of IRS liens and then right when that came in, there was a government shutdown and the IRS office all closed down. And then basically escrow couldn't get a demand from the IRS, and it delayed closing, I think, for like another 3-4 weeks or something like that. So really bad situation. But that's, you know what, I think my time is almost up. I even went over a little bit. Does anybody have any questions before we start wrapping this up? If you guys don't have any other questions, Eric and my contact, they're in the chat box. I mean, we do appreciate you guys coming on here. We hope this was helpful. You know, we're here to educate and also earn your business. So next time that you guys do have an opportunity to direct title, we really sincerely hope that you keep us in mind for your next deal. We would love to work with you. We always review the prelims for you, so that, you know, if there's any red flags, we try to notify you as soon as possible. We tell you that, hey, you need an SI from the seller. We try to be proactive because we don't want to see the files. You put so much work into them, delayed in closing. So I want to thank Tri-Counties again, and thank you, Eric, for helping us well. And yeah, that's it. Thanks, guys.
Thank you, Jerry. Thank you, Eric.
Yeah, thanks, Laura.
And Laura, this is being recorded, so I guess if anybody wants this, they can contact you for a copy?
It'll actually be on the Tri-Counties website. So all the
Okay.
classes are recorded on the Tri-County and put on the Tri-Counties website on the education page.
Awesome.
So
Thank
even
you so much.
your past classes are on there as well.
Oh, okay, awesome. All right, well, thank you, Laura. Yeah, go on the page if you guys want to. And thank you to Aria, Tri-County, for actually being on this call as well. I know some of the president and key people are on here to help support. So thank you guys. And thank you. Have a good rest of your day. Take care.
Bye.
Thanks, guys.